Hey, there's a bubble.
In 2007, the housing market was on the brink of a financial disaster, and while many were oblivious to the impending crisis, there were a few who saw it coming. You probably know Michael Burry because of his predictions, but there was another who foresaw the chaos that was to come. Steve Eisman, the man played by Steve Carell in the movie The Big Short, made millions betting against the banking sector, and now he's back with a new ominous prediction. In this video, we'll take a journey into the mind of Steve Eisman, the hedge fund manager who warned us of the subprime mortgage crisis. We'll explore his latest outlook on the US banking system and what he predicts could be the next financial catastrophe. So, you should stick with us as we delve into the predictions of one of the few who saw the last crisis coming, and could be one of the few who can predict the next. The recent chaos on Wall Street has been causing quite a stir among many Americans, who are becoming increasingly anxious about the possibility of another financial crisis, similar to the one that rocked the world in 2008. However, while comparisons have been made between the recent Silicon Valley Bank (SVB) collapse and the Lehman Brothers bankruptcy 15 years ago, Steve Eisman is confident that the current situation is not a return to the financial crisis.
You know, as Warren Buffett says, when the tide goes out, you see who's naked. This is a different tide. This is not a credit tide. Credit quality in the United States is really good. This is a tide.
In an interview with CNBC, Steve Eisman confidently asserted that the recent banking panic is not a recurrence of the 2008 financial crisis. Eisman emphasized that the problem is limited to a few regional lenders, similar to Silicon Valley Bank. He further said that the current turmoil is manageable and does not present a systemic risk to the economy. Eisman's assertion is backed by his position as a senior portfolio manager at Neuberger Berman, a prominent financial firm. He explained that the situation is different from the 2008 financial crisis, where the largest banks in the country were involved. If those banks had failed, it could have triggered a devastating economic fallout. In contrast, the current scenario is confined to regional banks that have highly concentrated deposit relationships, which are mostly above the $250,000 limit. These banks have made some poor financial decisions that have led to the current crisis. So, Eisman doesn't believe that the past will repeat itself. According to him, improved regulations in the financial system have created a much safer environment, minimizing the likelihood of another crash. Although Eisman acknowledges that the memory of the 2008 financial crisis has left some investors shell-shocked, he also recognizes how much the financial structure of the United States and Europe has transformed since then. He argues that those who fear the markets are poised for another meltdown are mistaken. He explains that 2000 and 2008 for some investors is like PTSD, but the reality is we have much more stable banks, much better capitalized banks, much more liquidity in the market. So, while something could happen, we're not going to have some enormous meltdown crisis where the system is completely at risk, which is what happened in 2008. Eisman believes that the reality will be much more mild. Meanwhile, he anticipates an old-fashioned run-of-the-mill recession. He believes a paradigm shift is coming. What does he mean by this, though? Well, right before we jump into that, Steve Eisman isn't the only one who believes that the current financial turmoil, although still dangerous, is not as dismal as 2008. His outlook is similar to that of Treasury Secretary Janet Yellen. During a banking conference, Yellen stated that the current situation is not comparable to the 2008 solvency crisis, but rather has been driven by contagious bank runs, triggered by the Federal Reserve's rapid tightening. She emphasized that the recent turmoil is not caused by bad loans, as was the case in 2008. So, although the recent turmoil in the banking sector isn't like that of 2008, however, that doesn't mean that there won't be more pain in the financial sector before the dust settles. Meanwhile, Steve Eisman believes that a paradigm shift is coming. Over the past decade, the Federal Reserve's decision to maintain near-zero interest rates in response to the Great Financial Crisis and the COVID-19 pandemic has fueled the outperformance of tech and growth stocks in the overall market. These firms were able to easily invest in revenue growth due to low borrowing costs, and with limited alternatives to equities, investors were incentivized to take on risk and invest in them, according to Eisman. He further noted that the phenomenon of Amazon disease had gripped the market, where investors chased after the next Amazon-like success story, often disregarding fundamental financial metrics such as earnings. During the period from 2010 to the beginning of 2022, Eisman argued that companies with strong revenue growth but no earnings were highly valued by investors, as they were seen as potential dream investments hoping to replicate the success of Amazon.
Side of the banking sector.
I think what's happening is we're moving from one paradigm to another paradigm. So the paradigm of the last several years has been rates are very low, you're paid to take risk, and you're actually paid to take a lot of risk. So, what did the best over the last 10 years? High growth tech stocks. What did the worst last year? Super high growth stocks with negative.
Eisman is of the belief that the landscape is changing as the Federal Reserve raises interest rates to fight inflation. He predicts that revenue growth at many of these companies is now slowing down, signaling a paradigm shift for investors. In a recent interview, he told Bloomberg, sometimes paradigms change violently, and sometimes those paradigms change over time, because people don't give up on their paradigms easily. So Steve observed that paradigms can shift in two ways. Sometimes the shift happens suddenly and violently, while at other times it may take longer for people to give up their old beliefs, leading to a more gradual shift. Eisman believes that the current period may be one where the paradigm shift could occur either way, and investors need to be prepared for this transition. The paradigm Eisman is referring to is the one that followed the 2008 financial crisis, where central banks reduced interest rates to zero and kept them low for an extended period. This policy fueled the growth of the tech industry, and companies such as Apple, Google, and Meta led the market for over a decade. However, Eisman warns that this free money era may be coming to an end due to rising borrowing costs. Despite the central bank's effort to manage inflation by increasing interest rates from nearly zero to just under 5%, inflation remains well above the target level of 2%, having risen to 6% last month. This move was aimed at controlling inflation. However, it has presented challenges in maintaining a balance between the fight against inflation and supporting the economy. Traders anticipated that the Federal Reserve would continue its efforts to combat inflation by raising interest rates by 25 or 50 basis points. However, recent bank collapses have led to speculation that the central bank may halt its campaign to ease the financial markets' anxiety. According to Eisman, halting the tightening campaign could result in a resurgence of inflation, and he believes that neither decision by the Federal Reserve is straightforward. The central bank is in a challenging position and must weigh the consequences of its actions carefully. It's uncertain what the future holds, and the financial market's uncertainty is growing with each passing day. With that being said, thanks for watching, and we'll see you in the next video.